Yeah, welcome to another webinar by DigiShares. My name is Jonas and I'm today's host. And in today's webinar, we'll leave aside the tokenization of equity for a moment and instead focus our attention towards the tokenization of debt. And as per usual, we have invited industry-leading experts on tokenization for the webinar, who today will help us better understand the role of tokenization within debt financing. But before we invite our speakers on stage, let us just briefly cover the rules of engagement. So as always, if you have a question for a speaker while he or she is doing a presentation, please type the question into the Q&A, and please remember to specify who the question is for. So simply type in the name of the presenter, followed by a question. And after each presentation, we can then take a few questions if there is time for it, and if not, we'll try to save them for the panel discussion at the end. And also, please note that sometimes if our speakers have time to spare, they'll enter the Q&A after their presentation to answer your questions. And if you have any general inquiries, feel free to use the chat where our moderators will sit ready to answer them. Also, if there are any technical issues during the webinar, such as the speaker being muted or a screen not being shared, please notify us using the chat. So that's basically it. That's the rule of engagement. And now let us move on to an introduction of today's presenters. First off, we have Klaus Goning. Klaus is the CEO of DigiShares and will, as always, be giving a tokenization industry status update and talk about the current traction of DigiShares. Following Klaus, we have Olivier from BridgeDefi and Raquel Batista from Lighthouse Consulting will be giving a presentation on green bonds and debt finance. After Morne and Raquel, we have Efri Argaman from OwnEZ Inc. Will talk about tokenization of residential real estate backed debt. Then after Efri, we have Swapnil Pawar from ASQI, who will speak about tokenization of debt on a distributed ledger, options, benefits, and limitations. After Swapnil, we have Simone Domenico from Fintech Legal Center, who will talk about tokenized debt from a regulatory perspective. Following Simone, we have Maurice Crespi from Schindlers, who will present their perspective on debt tokenization. And then we have Axel Goldbeck from Möhrle, Happ, who will talk about tokenization of debt in Germany. And then finally, at the end, we have Bryony Widup, who will speak about tokenization of debt from DLA Piper's perspective. And then at the end of the webinar, we will, as always, have our fireside chat where today's presenters will answer some of your questions and discuss the topic of today, namely tokenization of debt. So if you have a question you'd like to ask the panel, please feel free to type it into the Q&A and remember to specify it's for the panel. Yeah, so that's today's program. And I would now like to present today's first speaker, Klaus Goning. Klaus has a PhD in computer science, specialized in AI, and has taken out 7 patents. He's a serial entrepreneur, having co-founded more than 5 companies so far. And for the last 5 years, he has been focused on blockchain, where he also co-founded DigiShares 4 years ago. And Klaus will now give us a tokenization industry status update and shed some light on the current traction of DigiShares. So welcome, Klaus.
Thank you. Can you hear me?
I don't know, I cannot hear you.
You cannot hear me. How about now?
Better, yeah.
Better?
Still a bit low, but I think that will suffice.
Yeah, we'll have to live with it, I hope.
Yeah.
Hope we can. So yeah, welcome everyone to this webinar about tokenization of debt. My name is Klaus, I'm the CEO of DigiShares, and we are hosting the webinar here today, as we've done several times before. We provide a tokenization platform, white label tokenization software system, basically for tokenization of real world assets. I would say 95% of all the projects we have completed until now have been where we have been tokenizing equity or shares, and only in a few cases we've been tokenizing debt. But we see quite a clear trend with more and more cases appearing where our clients want to tokenize debt or loan instruments of different types, and that's why we wanted to shed some more light on it here today. It's a different type of security, and it has different properties in relation to tokenization and regulation and so on. So it can be a better choice in some situations and give different value. So the focus is on debt today, and this will be the last webinar from our side this year. Next year we are planning another 8 webinars, and we are sort of making plans for the topics right now. If there are any ideas, feel free to send them to us. We are conducting a masterclass also in the end of November in London, after having done several masterclasses over the last few months in both Vienna, Miami, Las Vegas, and in Silicon Valley. We are coming to London. Another piece of news is that we are going to do a public round on the public in the US, hopefully within a couple of months, to further fundraise for the company's expansion. Let me share a few slides as well here to say a bit about the industry status as we view it. Last year we published an industry report about real estate tokenization, and we actually are close to publishing a new edition of this industry report. It will come out within a couple of weeks with updated industry statistics and industry information about how tokenization is developing as an industry and as a market concept. We see, I think we can reveal already now that these trends are continuing and that the market is still growing quite strongly, and that we see more and more investor interest into it as well. One of the big, I would say, elements of tokenization is the idea that we can fractionalize and democratize and sort of make it easier for retail investors to get access to real-world assets as an investment object, sort of to make equal opportunity for both retail investors and high net worth investors, and possibly help retail investors get access to this asset class in order to diversify and protect their savings. But we need, of course, for the retail investors to understand that they now have the opportunity to invest into tokenized assets and actually start doing it. From our side, we think that the adoption of retail investors will take a similar trend as we have seen with the growth of stock trading over the last 20-30 years, or the REIT market, as it has been sort of slowly adopted by retail investors, similar to the ETF market and so on. We just think it'll go faster because it's fully digitized and it's much easier for retail investors to gain access to it today. So hopefully we will see a trend similar to this over the next few years, where we'll see massively increased private funding into the asset class of tokenized assets, especially from retail investors, but hopefully also from institutional investors. Otherwise, we see more and more regulation in our space. Of course, we are sort of fully within the existing securities regulation, and so the changing regulation doesn't influence us that much. But I would say regulation that strengthens the crypto market overall also benefits us. We also see more and more focus on decentralization. More and more exchanges are coming out, and an increasing percentage of the exchanges that are out are actually decentralized. So the decentralized business model seems to be winning over the centralized one. We see more private capital flowing into the markets. We see more and more crypto adoption, of course, and of course the overall tokenization industry also benefits from this trend. We also see more and more institutional adoption. We see a lot of big institutional investors investing into companies in the space, and also tokenizing increasingly their assets. We are working on supporting a specialized blockchain for security token coming forth within a couple of weeks or a couple of months, I think, called Polymesh. This is the first blockchain that is fully focused on the processing and the safe transacting of security tokens. So that will be quite exciting. It's created initially by Polymesh, but now, of course, it's an open industry standard that anyone can use. And I think that we will probably be the first sort of issuance platform to make use of this new chain. So I think I will end here and pass the word back to Jonas. Thank you very much.
Thank you, Klaus. Okay, so next presenter is Morne Olivier and Raquel Batista. And Morne Olivier is from BridgeDefi, and Raquel Batista is from Lighthouse Consulting. And Morne is the founder of Business to Blockchain Incubator Consulting Services, and he recently partnered with BridgeDefi to develop the green carbon token and took up a position at BridgeDefi as their new business development specialist. Their goal is to bridge the gap with decentralized finance and to develop Web3 blockchain solutions that matter. Accompanying him today is Raquel. She's the attorney handling the registration of green carbon token in Portugal, and they will now give us a presentation on green bonds and debt finance. So welcome, Morne and Raquel.
Thank you.
Thank you.
Thank you very much, Thomas. Yeah, thank you. Thank you, DigiShares, for the opportunity. And hi, Raquel.
Hi there.
You well?
Good. Always good.
All right. So yes, so today we'll take you through a bit about what we intend doing with green carbon token and a bit of a comparison with BridgeDefi and how tokenization of debt or on the other side, tokenization of capital will benefit the industry or the climate impact industry going forward. Sorry. All right, so we view blockchain technology as a gateway to databases. It synchronizes and secures the information onto those databases, and with that, over the last decade or so, a few verticals has risen. Cryptocurrency, probably the most famous one, and when everybody says blockchain, they think crypto. But obviously there's a lot more to it. The distributed ledger is in fact, the most the biggest part of the integrity of the whole software system. And with that integrity, it is what the information is we want to use and take forward, building that transparency and open communication. Other verticals like tokenization, tokens or utility tokens, NFTs, and NFTs have risen and have become very favorable over the last few years. We see tokenization as a form of a wrap almost, where we can wrap that asset into a digital space on the blockchain and use that as a vehicle to move value around much faster and efficiently than we currently see. So why tokenization? The tokenized assets are basically, like I said, wrapped in a digital format. We call it minting. So tokens are minted with a link to fungible value. So documentation pertaining legal information is digitized and then utilized on the blockchain on platforms to trade or to prove or to use efficiently between two parties. The green carbon token, as such, we see as a vehicle of financing for climate impact ventures. And doing that efficiently is so much more important. Well, it's very important, as we know how climate change has impacted the world over the last few decades. So currently we have, scenarios where that finance to those ventures that are building and producing quality products for climate change. I would say in the normal world, we find it very encumbersome. So finance takes very long to get to them. It is very involved with third parties and very costly. And it's also secluded in a small section in comparison to the global population. So quite secluded. So what we intend to do with Green Carbon Token is tokenize green bonds initially, which will provide efficient finance for these climate impact ventures, and in that respect, offer B2B and peer-to-peer value trade. So the financing or the debt financing, that instrument is still the same. It's nothing changes about how you agree upon taking on that financing and paying it back. The efficiency part behind it is just much more impactful as well, because it's direct, it's costs less, and it's much more transparent. And on the blockchain, all those informations are you can't change it, etc., etc. So we see the green bond vehicle as a desperate need for the climate industry, and what it needs to do before net zero implications. The private market is a little bit more tricky with carbon credits, a bit more grey, where there isn't much regulatory regulation happening. But we do intend to code the green carbon standard on chain and provide sufficient or efficient tools for the private market to tap into to connect on chain. And that's going to be very important. That'll take away all the guesswork out of blockchain for the normal private person or company. There's a large need for that in the private market. So yeah, that's one of the longer term goals that we intend to do. Then on the other side, we have the company that I work for, BridgeDefi, who's chosen a slightly different route in tokenizing or using tokenization as an asset in their business. So NFTs are tokens, non-fungible tokens, and they've decided, instead of using coins or ICOs, to use NFTs to raise funds for various ventures, various businesses going forward. NFTs and the smart contracts takes away a lot of risk for the investor. When you look at tokens or coins being pumped and dumped, NFTs take away all that risk. And also the NFT smart contracts holds automation, where licensing and royalties and profit sharing can be done in multiple stages automatically after reaching certain milestones. So that's also a feature that we'd like to bring into the Green Carbon Token, maybe down the line, but because it's not quite as regulated as you would find the tokenization of bonds or securities, it is something that we'll have to work with the regulator going forward. And I think here I want to invite Raquel in quickly, and just to give her her input on both those scenarios a little bit more.
Yes, hi everyone. Thank you for having me. I think what you said, Morne, is very important, and I think what we're assisting now, and I come from a banking traditional background of over 20 years, so all of this new reality for me is quite a confrontation with everything I've ever lived professionally in my life. But what I think is what's now starting to happen is the reality is overcoming the structures. So there's two ways. Either the regulatory approach is welcoming and does not confront the reality of what's already happening and what everybody's doing, and welcomes alternatives and welcomes players of the market, and in that way you can kind of integrate both worlds. Or, you know, if they take a completely shut off approach, then what I think we'll be seeing is this tokenized crypto world getting smaller and smaller into you know, communities that are aware of what it is and how it works. I do not see this happening. So what I see is an approach, or maybe it's wishful thinking, I don't know, but what I see and what I've started to see is, in spite of some regulation that tries to regulate certain aspects of NFTs or crypto or whatever, there are also initiatives that try to pull together the crypto world and whatever initiatives are happening right now with a regulatory approach. So what we would like to do here specifically in green carbon tokening is exactly to merge those two realities as close as it could be. So especially because this is an area with debt tokenization and the green carbon and whatever that has a long past in the real world as securities. So what we're doing now is like giving another layer or another package to something that's been done over centuries and centuries, which is someone lending money to someone else. So I think that as well as the politics and all the administrations of the countries and the European and American institutions are doing, I think we ourselves as players also have the duty to try to approach them, you know, in a communicative way and try to get close to them and work with them together, as opposed to, you know, just hide in our own corners and do whatever we like the way we wanted to do. So I think this is going to be very interesting in the near future to see exactly how the two realities clash, how the two players will treat one another, and if there will be closeness in the two worlds. Because Morne, I think you're absolutely right to have some type of regulatory concerns or some type of similarities to the real world where people are used to making investments and such will help to democratize and to spread these types of mechanisms into regular people that are not, you know, sophisticated internet or whatever TI people. So I think that's very important. We are like in one of the major times to exactly, you know, point the fingers each way. So I think we have the responsibility as well as agents of the market to make that step as well and try to do it, you know, in the way that will protect the consumer in the end. Because, you know, the worry, the preoccupation of the regulatory system is to protect the consumer. So I think if we have that concern in our minds as well, I think the communication is possible, and I think we can meet, you know, halfway in some having some regulatory preoccupations and some safeties and some safeguards, but, you know, do whatever we want to do and bring everything closer to the common citizen without having all these old structure of big banks behind.
Yeah, no, I fully agree. And that's probably one of the main points I probably want to take away from this is that, you know, I think we passed the level of explaining what a blockchain is. I think we need to move on to how it's going to be involved in the current world that we live in, and finding those businesses and those companies that is willing to make it a part of their or a foundation of their companies, and then start using it. it's a absolutely brilliant, efficient tool to use. So why not? They don't need to know what a blockchain is and what it does. They just need to know that it's efficient and save them money and all other stuff that you can imagine scales a business. It's going to do exactly that. Some aren't particularly, there's always a certain package that fits with a certain business. So those things are things we can chip away at and find out, and that's why we're here to advise on that, or to help people go through the jargon and get to the real stuff, or the real companies that does it has the real benefits. But that's why we're here. That's why we're on the webinar, to share the information and to be in contact with. So yeah, just quickly before we wrap up. So database and ledgers, basically what a blockchain is. And yeah, the advantages: store of value, the integrity behind that value because of the immutability of the chain. It allows for versatile utility and trade efficiency, which you've spoken about. And yes, then it offers a wider participation. So especially in the private market or for the normal citizens, they are able to join into this big economy that we're busy building. And I think the way we package it and present it to them as a more efficient vehicle moving forward is important, because they don't necessarily need to know that it's a blockchain. They just need to know that they can push a button and be involved, and that's very, very important. So yeah, bridging the finance, that's what we do. That's what our intention is. Our intention is to bridge the normal world that we currently live in, normal retail, normal venture, normal business and company owner, into the financial side of the blockchain and the efficiency of that. For most part of it, it's a peer-to-peer or business-to-business model. So a lot of third-party costs and time, bureaucry is cut out. So just in that, if you don't see the value, then it's a value add. And that's why I'm almost finishing up with this, saying that to grow your business is really essential to adopt that tokenization model, to raise capital, to loan capital, to pay it back. All those normal financial ways of doing business still stays the same. We just bring a tokenization package to the table and we make it more efficient. So that's really in a nutshell what it does. And yeah, thank you very much. That's it from us.
Thank you so much, Morne. Thank you so much, Raquel. I hope to see you at the end of the fireside chat.
Yeah, I'll stop sharing.
Sure. Okay. So next speaker up is Efri Argaman, who's the CEO and founder of OwnEZ. And Efri is a seasoned leader of both publicly traded and private tech companies, who also happens to be trained as a CPA. After years of leading companies, Efri decided to follow his passion and make his hobby a profession. He's been actively interested in the residential real estate market since 2009. And currently, through OwnEZ, he's helping more people obtain home ownership via a buyer technology-based solution using proprietary algorithms. And Efri will now be covering tokenization of residential real estate backed debt from people to the people. So, Efri, scene is yours.
Good morning from Austin, Texas. Thank you for the opportunity to be here this morning. Of course, I will share my screen as well. Let's make sure that I share the correct screen, though. Okay, I think we're good. Perfect. Okay, so I'll talk this morning a little bit about our business case, how we joined forces with DigiShares to build our future. And first of all, John, as you said before, that we will not talk about tokenization of assets this morning, but about tokenization of debt. And in my perspective, that is an asset. There's not much of a difference. So few words about OwnEZ. We're a tech-enabled homeowners loan lending platform. Basically, we take care of the underserved population of people that can afford buying a home here in the United States, but have no access to conventional lending because of the system. We developed our own proprietary underwriting algorithms that take into consideration data points that are more relevant from our perspective to predict whether a borrower can pay or cannot pay their home loans. We started in 2017 as a bootstrap startup. We are still a bootstrap startup. Launched our business in 2019, and currently we're a licensed lender in 8 states across the United States, and we are growing. In terms of the problem that we came to solve, and there are several problems. So as I said before, we are targeting people that can afford buying a home but have no access to conventional lending. It's a relatively big problem. The system here relies mostly on a credit score system that is pretty much antiquated and relies on the credit consumption history rather than trying to predict whether a borrower can actually pay back the loan in the future. So we resolved that part of the equation. On the other side of the equation, of our platform, we have investors that want to invest in cash flowing, high return real estate, but don't want the headaches of being landlords. And our challenge always is to keep the balance between the borrower side and the lender side, because the lender wants to make lots of yield. The borrower doesn't want to pay a lot of money, and we are in the middle trying to keep the balance. In terms of our solution was to transpose the auto lease finance model to the housing industry. So basically, the way we do what we call reverse underwriting. We firstly analyze the borrower, come to the conclusion of how much of a house they can afford, and then they go on the market, look for a property, identify the property, and then we step in, buy the property for cash, sell it to them on terms. And on the other side of the equation, we create a financial instrument that is generating cash flow and is secured by real estate. And investors can invest in this financial instrument. We've been doing so successfully, and so far, using our algorithms, our default rates are significantly lower than the industry, about 25% of the industry. So if the industry default rate is close to 8%, we have a default rate after 3 years now, 4 years, of less than 2%. Our first step in building the platform was to build a home buyer site, which we built it with technology at core. Basically, we centralized the underwriting, processing, customer success. Everything is centralized, everything is cloud-based and technology-based. We are a company in the cloud. In reality, even though we have legal offices, nobody is in the office, and we have a front-end and back-end systems that are connected, and our customers or borrowers can actually approach us either through traditional ways or through any interface that is available out there today. The second problem, as I said before, we have many problems, is how to get the capital and how to save costs. So basically, traditionally, the industry is working with mortgage-based securities. The idea, or the way that it works today in the conventional lending system here, is that a pool of loan is being bundled into a bond, and usually institutional investors or government agencies will just buy these bonds It's risky for the investors, it's costly, it's limited in structure, has very high maintenance costs, and has extremely bad reputation. I don't know how many of you saw the movie The Wolf of Wall Street, and everybody remembers 08 and Lehman Brothers. So, but that's a viable option that is still out there today. The other option, that this is how we financed our deals until today, was to build investment funds. So again, it's high cost of capital, it's not flexible. We have medium maintenance costs. It's not liquid, meaning that an investor, when he buys into the position, if he needs to liquidate his position, we have to sell mortgage notes. We have to sell some of our debt in order to become liquid and provide the investor with liquidity. So it's difficult. It's limited to accredited investors. So again, today, if we want to raise funds, we are limited to accredited investors, which puts our entry point token, or I'll use another phrase in token, not to confuse, but the entry point investment is relatively high. We are limited in offering, and it has zero flexibility, meaning that once we structure the financial product, we have to stick to it for the long term, and we don't have flexibility. So we started to think what will be our next step, and we were thinking, okay, what we had the tool that allowed us to break a pool of loans that we see it as assets into many pieces, take out the middleman, have a trusted mechanism to manage flexible liquid financial instruments. So we started to explore into this because we wanted to build an infrastructure that will allow us to finance our deals as we grow. And the next step for us was to put actually a sketch of what we are looking for, and this is at least the DigiShares people that are on board probably have seen this sketch before. This is what we introduced to DigiShares when we approached them last year, and we said, okay, these are our requirements. We want to create many-to-many relationship. We wanted to be able to have multiple loans financed by multiple investors. We wanted to have flexible financial products, because basically we can build a financial product that will pay principal and interest, or will pay interest only. We'll just accumulate value as we reinvest the incoming cash flow that comes from our loans. We wanted to be able to have an effortless recruitment of different kinds of investors, accredited, non-accredited, to be able to manage bidirectional transactions, because we get money from the investors and we disperse money to the investors from the cash flow that the loans that we originate create. So we wanted to have seamless ongoing maintenance, because today the maintenance of our funds, and we are in the process of raising our fourth fund, is extremely time consuming and expensive. And we wanted also to have future option to use multiple fiat and cryptocurrencies, because today, you know, we can accept today investments only in US dollars, obviously, because we lend the money in US dollars. Certain issues about how we hedge the exchange differences and such, but we wanted at least to have the future option once crypto will become a mainstream, and I think it's going to happen at a certain point. We want to have this option, and on top of everything, we wanted also to be able to provide liquidity to our investors. If somebody wants to sell their position, they have to be able to do so. So basically, our next horizon is to take the money from the people to the people, and actually to enable multiple investors to assist multiple homeowners. So in a way, we want to be able, as I said before, to eliminate the need for the middleman and to improve the trust amongst transactors. which is extremely important because, you know, the way we grew as a bootstrap startup, when we reached out initially to our investors, we started with our own money, friends and family, second circle, third circle, and then we had a fund manager out of New York starting to bring money from Wall Street to Main Street. And as you go to the outer circles, you need to increase your trust because people don't know you. So using this infrastructure for sure improves the trust among transactors. It acts as a record keeper. And basically, the solution, the structure of this solution will allow us to have a cookie cutter solution that we can copy paste each time that we have a pool of loans that we want to securitize and actually break it into small pieces to tokenize it, enable us to reach all kinds of investors with no limitations or with less limitations. And of course, to improve the liquidity and enable money transactions from the people to the people. In terms of our next challenges, so as I said before, we are working with DigiShares diligently to stabilize the technology that supports the business flow, considering all the aspects that are involved. We have to choose the regulatory path and implement it. So basically here we have a few options. The SEC introduced certain regulations that could accommodate our situation. It depends on of which kind of investors we want to approach and what is the size of the transaction that we want to have. Most likely, so we have regulation CF, which stands for crowdfunding, but also reflects for such transactions that enables issuers to raise up to $5 million every 12 months. There is regulation A that goes for the same for $75 million. Both regulations enable the issuer to approach accredited and non-accredited investors. And of course, as we grow, we can use also the traditional options of regulation S, regulation F, which are similar to have a full-blown IPO. I think that the largest challenge that we will be facing is the challenge of how we market the token. You know, still tokenization of assets in general and tokenization of debt specifically are in infancy here in the US, and our product is not the typical you know, Reddit Reddit product that blows off the mind of millennials, because it's a semi-solid product backed by real estate, provides decent yields in comparison to cash deposits, but not crazy dreams of hundreds of percents of yield. So this will be the challenges that we'll be facing, but I'm extremely optimistic that that we are going to solve these challenges and meet our goals. Thank you.
Yeah, thank you, Efri. And I hope to see you at the end for the fireside chat.
Of course.
That's good. But thank you for now. Okay, so next up is Swapnil Pawar, founder of ASQI. Swapnil was a portfolio manager for India strategy at Engineers Gate, a US headquartered global quant hedge fund, during October 2015 and May 2019. He later acquired the Indian business Engineers Gate through a management buyout and formed ASQI Advisors to create an asset management business focused on absolute returns in Asian markets. Swapnil has an experience of over 15 years, spread across quantitative strategies, alternate assets, fundraisings, and business building. Swapnil has been recognized as one of 40 under 40 professionals in alternate investment space in India. He has also authored a book titled Anatomy of Fraud, Demystifying the Global Financial Crisis. And he'll now speak about tokenization of debt, debt on a distributed ledger, options, benefit, and limitations. So, Swapnil, Welcome.
Thanks, Jonas, and thanks DigiShares for this opportunity to speak on a topic very close to my heart. It's customary in Web3 to speak of your why, as to why specifically you got into this domain. For me, it's essentially the immense potential, revolutionary potential even, of decentralized smart contracts and autonomous organizations to bring about financial inclusion and a real change in the lives of multitude of people, especially in the bottom half. Now, debt markets in particular have been very centralized till now, and they essentially are hard to access for investors and also for small businesses. So as borrowers as well as lenders, it's very top-heavy system, to say the least. And it's actually quite interesting to explore if blockchain can solve some of the crucial impediments which keep debt markets from becoming more decentralized, diverse, and egalitarian, if you will. So with that background, let me just share my screen. Quick word about us. At ASQI, we're building a layer 1 blockchain called Möhrle. It's focused on mainstream use cases, exactly like tokenization of real-world assets and real-world contracts. It's essentially a decentralized trust network, a social graph of identifiable real individuals and small businesses. So think of it as WhatsApp meets Ethereum, and then they meet a credit bureau. So it's history aware in some sense. So it's a decentralized network which allows you to transact value, not just exchange messages, but also collaborate in a decentralized manner. And most importantly, alters your trust score based on the honesty of your behavior or the lack of it. So we're trying to combine all of this into a single network and then make that network the infrastructure for tokenization of assets, but as we will see later in the presentation, native issuance of it as a business, which could be off-chain or on-chain for that matter. Now, before we get into how to tokenize, some thoughts about why tokenize in the first place. And my personal favorite of an approach is to not implement Web3 solution or a blockchain solution where it doesn't add value beyond just a marketing hype, right? So we need to ask hard questions about whether tokenization of debt improves something for either the issuers or the investors. The good news is it does. And as we heard earlier as well, the fractionalization of debt already adds a lot of value because unlike equity, debt has been typically very large ticket size. Depending on the jurisdiction, it could be $100,000 or $1 million, maybe even higher. So access to investors of all ticket sizes and ability to sell smaller units. Even if I am able to buy a large chunk, it doesn't mean that I can sell that off just as easily or partially sell it. You can also then bring about innovations from the Web3 domain, such as decentralized exchanges or peer-to-peer transactions, because on blockchain, it's much easier to establish trust or operate without it for that matter. There is immediate settlement, no counterparty risk. You can release a lot of money stuck in guarantees given by brokers to exchanges and so on. Lastly, ownership records are immutable. There is no need for a centralized custodian to figure out who owns what. And lastly, even for advisors or even product innovators, just as we saw in the previous presentation, you could actually tranche multiple types of cash flows into any amount of innovations without having to go down the path of an opaque system, which obviously brought about the financial crisis in some sense in 2007, but something a lot more transparent and a lot more immutable in the form of smart contracts, which actually can slice and dice your cash flows in 10 different ways and match the risk with a risk of a specific security with the risk appetite of the investor of that. Having seen that we could potentially benefit a lot from tokenizing debt and bonds and all other debt-like contracts, let's look at how we could do it. In ASQI, we keep doing this analysis of real-world tokenization, real-world asset tokenization, and we keep coming across this realization that it's not a technology problem. It's not, or more importantly, it's not just a technology problem. It's a lot more than that. It's a technology, legal, regulatory compliance problem put together. And then you have to add incentives on top of all of that. So the answer is part technology, part legal. And in that context, the three modes that we have essentially zeroed down upon in terms of possibilities of how you can tokenize debt. One is custody-based, and we'll see the details shortly, but it works very well with existing securities. You don't even need the approval of the issuer for this. You just take this beneficial interest of that security and transfer it to the owners of tokens through a formal legal agreement, which differs jurisdiction to jurisdiction. In most cases, we think of them as bearer assets. Whosoever has the token has the beneficial interest. And it still obviously leaves the custodian risk because there is a custodian required in between who holds the actual securities. Contract tokenization is a bit simpler because the native issuance then eliminates the custodian from the equation, and payments can still remain fiat, and obligations can still remain what I call off-chain legal system oriented. The most advanced version is fully on-chain or fully native version, where tokens are issued by a smart contract and they are themselves securities, if you will. They embed all the cash flows in the form of the contract, and there is no fiat payment happening outside the chain. And all the contractual obligations also exist inside the smart contract code alone. They can be a legal document outside, but you rely as an investor and issuer on the smart contract primarily. Whereas in the contract tokenization, only ownership is essentially in that token. Rest of the clauses are sitting outside. And in the fully native version, obviously all your payments have to be on chain, but they can be in stable coins, BDC, and stuff like that. So here's the detail of custody-based issuance. There is an issuer which issues securities in a very conventional way to a custodian or a special purpose vehicle. This is what is recorded with the regulators in the conventional compliance form. And the custodian in turn gets money from the investors in just the conventional banking channel, fiat dollars, if you will. However, the custodian issues beneficial ownership tokens compliant with that specific jurisdiction's legal system, which are recorded on the blockchain, and so is this beneficial ownership transfer and ownership of the investor of these tokens. So in some sense, you're doing placement of these token securities or tokens with the investors, not the underlying securities themselves. The good thing is this, legally speaking, this arrangement has been already in operation well before blockchain came about. So if you look at the US system of how you actually own a stock, if you own Apple shares, for example, as a retail investor, chances are that your name doesn't show up in the share registry of Apple, which the company maintains, because they will maintain the name of the custodian who holds the shares on your behalf. And sometimes there could be 2-3 layers in between. So this system is already operational in a centralized ledger form. We just need to tweak it and say, it's now decentralized, and it's implemented in the context of debt securities or bonds. Contract tokenization goes a bit further, and we say that there is no custodian. The issuer issues the securities as tokens. The contract itself is tokenized. Because at the end of the day, unlike equity, which is ownership, debt is just a contract which has finite life and very specific cash flows. So it's, contractually speaking, simpler, cleaner, and easier to convert into a smart contract. So your token can actually embed all this, not the actual enforcement, but just the terms of the contract, and that issuance can be native. Of course, that depends on which jurisdiction you're talking about. In India, for example, it's not possible to do this necessarily. In some other jurisdictions, it's a bit easier. It differs, of course. But now the investor owns tokens, which are the securities. But they are securities in a conventional sense, in the sense that they are securities just like bond issued by another company is also a security. But their ledger is on-chain. Here too, you will record all your conventional compliance with the regulators as you would for a typical issuance. The next version is when you actually have native issuance, which is the most advanced form, which is entirely on-chain. Here, the ultimate utopian version is the issuer itself is an entity on-chain, like a DAO or which might have a LLC in the real world, but its primary existence is on-chain. But let's leave that aside. Issuer can be a conventional LLC or a LLP, but they don't actually issue anything as much as operate a smart contract. The smart contract is the debt then, which issues tokens of ownership, which the investors own, and the investors then transfer money to the smart contract, and the smart contract gives them repayments. All of this activity is entirely on chain. There is off chain, you could say, if the issuer wants to convert the money that's received into conventional fiat, then they can take that CBDC or stable coin and convert it into dollars and use it, and at the time of repayment do the reverse of it. But increasingly, if you believe that most of the payments can be settled in stable coins, then you might not even actually ever convert your USDC or USDT into fiat. They can simply pay people using USDC, receive back your revenue in USDC, and pay back the loan also in the same stable coin, in which case your entire flow is on chain, and the issuer is simply operating the smart contract. So all of this is obviously happening on a blockchain, so the flow is also on chain, unlike the previous case where fiat still flowed off chain, only the ownership was recorded on chain. So what are the limitations of all of this? Compliance with regulations. So most regulators still playing a bit of a catch-up with all the nuances of these three approaches we talked about. And then it gets fairly complicated and hairy depending on where you are trying to do this. We did the version 1 in India some time back, and it went through smoothly. I've heard of World Bank having issued on private blockchain some bonds, I think 2019 or so. So there have been instances, but I mean, it's still evolving. So compliance, of course. Second is taxation. Now, this gets complicated because unlike equity, in debt, you have very regular coupons. And so you can't wish it away, because in equity, you can say simply wait for the capital gains and then pay it. Token has the same treatment as underlying equity. It's simple enough. With coupons, it's a bit difficult because depending on your income range, you could have different tax rates. And if you put a SPV in between, then that could complicate, because the SPV obviously will fall in the highest tax bracket and you'll have higher tax payable there. If you have a tax deducted at source requirements, it complicates life further. So it could be a huge limitation unless the regulators step in and say, we exempt this vehicle from it and investors pay it, or the vehicle sits in a tax friendly or no tax jurisdiction. User adoption, the crypto savvy people can do MetaMask and all of that, private key, etc., etc. But for a typical user, it's a bit cumbersome to handle these plugin based wallets. Even things like if it's non-custodial wallet and you forget your password, in theory, you could lose everything that is sitting in the wallet. So it gets a bit tricky when it comes to non-Web3 users. Dispute management, where is the jurisdiction of the parties, who violated which regulation, could be complicated. And to me, the most important question is, how does the legal system handle decentralized smart contracts as legitimate holders of tokens? If I put my if I put my token in a staking pool and then something happens to the pool, or let's say I go bankrupt, and then do I own that token, or does the smart contract own it? And if you have to then get the smart contract into the analysis of my bankruptcy proceedings, then how do we go from there? So borrowing, staking, liquidity pools could get fairly complicated unless, of course, the legal system catches up and sorts them in some form. It could be as simple as saying, if the smart contract is not a person, legally recognized person, then the last owner remains the legal owner. I mean, the variations possible. Lastly, a simple gradual adoption path I would recommend, or we are thinking about, is let's start with existing securities tokenization, then go to native issuance just for tracking ownership, and then lastly go to a fully native contract issuing debt securities on chain. With that, then we could sort of get to the whole path while still being manageable throughout the process. So yeah, that's the long and short of what I had. Thanks again.
Thank you so much, Swapnil, and I hope to see you at the end of the webinar at the Fireside Chat. And to everyone out there, if you have any questions as we go along, want to type it into or ask a presenter or want us to discuss it at the end of the webinar, please simply type it into the chat. Or sorry, into the Q&A, not the chat. Okay. So next up is Simone Domenico, who's the head of legal and compliance at Fintech Legal Center. And Simone is specialized in regulatory compliance for fintech projects. Identifying weaknesses and risk are just a small portion of his job, and he prefers to find solutions that combine business needs with laws and regulations. And he'll now present us to Tokenized Debt from a regulatory perspective. So welcome, Simone.
Hello, Jonas. Can you hear me? Yes.
Loud and clear.
Hello everyone, and hello from Tallinn, Estonia. I'm going to share my screen. Okay, here we are. So I will try to deliver a short speech about the regulatory perspective on tokenized debt. Very short introduction. I am the head of legal and compliance and also the founder of Fintech Legal Center, member of MSI Global Alliance. We provide legal and compliance services to fintech businesses. One of my mottos is the law is always late. When it comes to blockchain projects, they happen before the law changes to be able to cover those new things in the market. The law is always late. The technology or the market are way faster than the law. According to the economic histories books, the first known bond was issued many years ago in the current Iraq. It was issued to guarantee the payment of grain by the principal. At that time, corn was the currency in that area of the world. Of course, since then, a lot of things happened also from a regulatory viewpoint. Why the law is always late? Because we all deal with a set of securities law and regulations that they change from jurisdiction to jurisdiction, but in each jurisdiction there is a set of pieces of law and regulations applicable to the issuance and management of security. And then something happens. In our case, new technological solutions are developed by someone who work in this field. And at that point, regulators all over the world must deal with something new that happened that was not regulated before. What usually happens is that there is a temporary step in which regulators try to enforce, by way of analogy, pieces of law and regulations already set and in some ways well used in the past, to the point that regulators, together with all the other stakeholders, understand that the set of law and regulations is not good enough anymore to cover these new technological developments, and the regulation changes, unfortunately, late if compared to when the new technological solutions are developed, launched to the market. In theory, corporate bonds could fit the blockchain because tokenized debts could model the entire lifestyle of the bond. So, sorry, the technology, the blockchain could model the entire life cycle of the bond. Representing bonds on a blockchain can speed up the discovery and the settlement of the bonds. Still, as one of my fellow panelists said before me, when it comes to corporate bonds, they are still pretty low tech if compared to other asset classes. In theory, in general, we can definitely say that traditional physical bond certificates can be substituted by digitalized debt instruments that can be issued on the distributed ledger. The blockchain can work in this sense. The technology can be the solution to fix some of the problems that the traditional issuance of bonds experiences so far. As we all know, regulators are responsible to address risks and ethically allow innovation in the financial services market. In light of the current framework, we can say that regulatory guidance and the blockchain can coexist. The problem that we are experiencing from a legal and compliance viewpoint is that the law is late and the blockchain arrived to the market too quickly, and the regulators and also lawmakers and other stakeholders didn't have time to prepare themselves, and they are now they are forced to deal with something new. They don't know how to manage, how to address. At least in Europe, it's pretty easy to say that security tokens are regulated as securities under MiFID II, and that debt tokens are most likely regulated as transferable and negotiable securities. So this is one of those cases in which there is a set of law and regulations, in this case MiFID II, that could cover the issuance of debt tokens. The matter is how, because MiFID has been written way before the market started to talk and started to introduce security tokens. We have many topics that must be taken into account. Swapnil mentioned some of them just before me. The blockchain is a borderless world. The token holders can be based more or less everywhere. So there is a matter of cross-jurisdictional issuance. Different tax and fiscal systems must be taken into account. In the country in which the token is issued, as far as we are able to understand in which country the token is actually issued, is there a requirement to get the assistance from a notary or not? And many other factors must be taken into account. Within the EU, the approval of security tokens, so also debt tokens, remain case by case. Lucky us, usually regulators take an approach under which substance prevails over the form. So on a case by case basis, they can understand, or they can allow private companies to issue bonds in the blockchain. Because it's a case-by-case decision and regulators are not created equal, the choice of governing law is, of course, critical. This is to say that in most cases, the country in which a company is established to issue security tokens in general, debt tokens, for example, is a critical matter. The project, your project, if you are planning to launch, to issue debt tokens, your project can be allowed or can be easy to be run in country A, and not so easy or even impossible to be run from country B. To identify the best jurisdiction is a critical matter, as critical as the technological aspects that we already discussed during this webinar. I would like to close this very short presentation by saying, and I would like to quote Raquel, who spoke before me, when she spoke about the relationship between the fintech world and the traditional financial system. Tokenized debt should be based on complementing the current market infrastructure instead of creating disruptive changes. Please take this note from a personal viewpoint, because tokenized debt could be a challenge, a pretty big challenge when it comes to dealing with regulators. The chances of success, so to get the required licenses, for example, could be higher if the approach is not to disrupt the market or to disrupt the approach of the regulator, while to offer the idea that with tokenized debt, the company is trying to complement the current market infrastructure. That's all from my side, Jonas.
Yeah, thank you so much for that, Simone. And then, yeah, I think you're totally right about the late, or the law always being late. I think that's a good saying that perfectly summarizes the world of fintech and law. Okay, so I think, yeah, once again, thank you, Simone. And next presenter is Maurice Crespi, who's the partner at Schindlers. And Maurice is managing and founding partner of Schindlers Attorneys. He joined Schindlers in October 1997 and became a partner of the firm in December 1998. Schindlers specializes in South African property law and is now at the forefront of tokenization of physical assets, with a particular emphasis on impact projects in the property sector. He's presently involved in the tokenization of over 1 million hectares of land on behalf of the king of the Möhrle people, so as to unlock value in tribal land burdened by legacy apartheid legal structures that restrict this prospect. To achieve this, Maurice also founded Schindlers Digital Assets, virtual nation builders, and NFT auditors. And Maurice will now speak about Schindlers' perspective on debt tokenization. So welcome, Maurice.
Great. Thanks so much, Jonas. And thank you to the audience. Thanks for being here. And hopefully I can add to what the brilliant speakers have conveyed thus far. So just to give you a brief history of how I got involved in blockchain, 3 years ago, just before the lockdowns and Corona, I decided to get very, very steeped into the
I don't know if can you hear Maurice?
No, I couldn't hear you.
No,
Oh, okay, good. I thought it was my internet.
no.
Not good.
I think it's Maurice's.
Okay. Yeah, so maybe in the meantime, I don't know. Let's just, until Maurice is back, let's just have a small chat. We can see there are some Q&As right now, which maybe in the meantime we can simply just address if some of you are up for it. So yeah, I see Maurice now logged off. I think the internet connection sometimes it's not too stable in South Africa. Okay, but let's just, yeah.
I could take the first question if you like in the meantime.
Yeah, that sounds good. Thank you so much.
The question is, DeFi has a lot of liquidity based on over collateralization and market value liquidations and works well. As we start to think about liquidity for security tokens, etc., how do we bring about the same level of liquidity in these tokens outside? And one of the questions we have routinely tried to answer for ourselves is exactly that. How do we get the innovations in Web3 to work for tokenized assets like tokenized bonds, tokenized property fractions, tokenized residential backed mortgages, and so on? I think the answer probably is partly Web3 and partly new innovations. And one such possibility is what we call mutualization. So let's say you have 5 tokens or 5 bonds, each of them illiquid, and the more the better. And you actually put them together and try to create liquidity using a protocol very similar to Uniswap, which is automated market maker with XY equal to constant logic. And that's vis-a-vis fiat or stable coins.
Okay, so
we have Maurice back. So yeah, I'll summarize that.
You can continue afterwards from now.
I'm so sorry about that. We have blackouts in South Africa. We have load shedding, and it just kicked in at the worst possible time. yeah, so to just get back to where I was, so I formed the first blockchain legal department in South Africa in 2017, got steeped in the tech, and then COVID happened. And when COVID happened, I started an organization, put together over 100 corporate partners called COVID. So it stands for COVID Business Rescue Assistance, largest pro bono initiative in South Africa. And through that, we've helped over 600 companies. But where I'm going with this is the king of the Ndebele actually approached us and said, can you help my people? Now we're talking millions of people in South Africa, including millions of hectares of land. And we've approached everything that we're doing for the king. We call it a kingdom rescue. It's now turned into a country rescue. But the idea is to use blockchain and to use tokenization wherever we can. We did so successfully for Lily's Leaf Museum, where Mandela was arrested. We put together a NFT of his arrest warrant, and we sold it for 130,000 USD, and we saved it. Now, as part of the King's project, we've been given these millions of hectares of land, and what we're doing with the land is, well, the problem is primarily it's a legacy of the past. The land is housed in trusts, tribal trusts. When I say a legacy of the past, I mean a legacy of apartheid. And the occupiers of the land cannot securitize the land in any way, because the trustees of the trust are really in control of the land, and they give permissions to occupy, but that's where it ends. And what's happened now with the advent of blockchain tokenization and companies like DigiShares, we can take that land and we can tokenize it. And there are two types of tokenization. The one is one can create liquidity over the land, but the second, which is really, really exciting, is we're taking the land and we're actually geofencing the land. We're using companies like UNL.global, who've created a digital twin of the entire globe, and we can create addresses, and we're working with the banks to actually NFT those addresses and to embed their credit terms in the NFTs. And that's what we do. What we're specializing in now is the convergence of tech and law. How can one actually do this? What are the legal terms that are required? And that gives you some context. Now, when it comes to the tokenization of debt in South Africa, the debt market is heavily regulated. We have a whole host of acts. I mean, firstly, let me say this, I consult with the regulators, and they don't believe that we're regulated. I meet with the Intergovernmental Financial Working Group, and they mostly believe we're not regulated. I take an opposite view. I believe we're very much regulated. And when it comes to the debt capital markets, we have the Banks Act, we've got the Commercial Paper Regulations, we've got the Companies Act, we've got the Currency and Exchange Act, we've got the Financial Markets Act, and we have the Financial Advisory Intermediary Services Act. And that regulation basically requires that if you're going to go into this space, you got to do so on the same footing as our bond exchange, which is a hell of a onerous. Now, what I think is important is when one approaches regulation, you've got to look at regulation carefully, and you've got to consider, is the regulation in relation to the primary market or the secondary market? So what I mean by that is, if you are going to be offering tokenized debt to the public, okay, by way of, let's say, an exchange, you're going to have problems, and it's going to be heavily regulated. You're going to need a license for the exchange. Before you go with the initial public offering, you're going to have to put together a prospectus. You're going to have to be licensed. If you're giving advice, you're going to have to get licensed by the regulators. But that's if you're offering to the public. Now, the nuance that's being introduced when it comes to the tokenization of debt, and what I think is very different, is the fact that you can now raise debt with the primary market not being the public. Your primary market can be a closed group of individuals, let's say companies that you associate yourself with, or partners, but a closed group. We have in our law, the Collective Investment Schemes Act, which basically says you're regulated unless it's with a closed group. Let's call it family and friends. Now, if one were to raise debt with family, friends, and friendly companies, you're not going to be hit by the regulation because it's a closed group. But then what happens when it comes to the secondary market? That's the big question mark, because now those parties who are the bearer of the bonds, they can now put those bonds on an exchange because they're not in the business of offering bonds, but they can still trade those bonds. And that's where the big question mark arises, is if there's a secondary market and you're not in the business of actually trading, but you do have and you want to trade and you want to put it on a decentralized exchange or you want to put it on one of the NFT sites, what regulates that? And at the moment, very little from our perspective. You know, I've gone back and what we're doing is we're looking at legacy laws and we're trying to see how can we take these legacy laws and really see if they apply and adapt them. And we've got acts here. I've got an act here. It's the Bills of Exchange Act, and it's a 1964 act. And it's to laws relating to bills of exchange, checks, and promissory notes. And many of these provisions in this act, going back to 1964, have been forgotten. They don't longer apply. A lot of the instruments, the debt instruments that are contemplated in the act are long gone. But what's amazing about acts like this, and I encourage attorneys to go back to the law books and to actually find them, is that one can find compliance with these acts in the tokenization space. So if I take the definition as an example in this 1964 Act in Section 2, it says we have here a bill of exchange an unconditional order in writing addressed by one person to another, signed by the person giving it, requiring the person to whom it is addressed to pay on demand or at a fixed or determinable future time a sum certain in money to a specified person or as order or to bearer. Now, there's nothing in this act that informs me, there's nothing in this act to suggest that the use of the blockchain or NFT space when it comes to the tokenization of debt would be unlawful. In fact, it would be regulated by this act, and it's actually good that it's regulated by this act. There are provisions here that are important, but that's between the bearer of the bond and the issuer. The moment the bearer of the bond now wants to trade the bond, where does the regulation kick in relation to those trades? Why would he not be able to trade it if it's not an exchange or it's not the bearer's business to trade the bills? And I think that's where, certainly in South Africa, there's a lacuna. There's a big question mark in relation to that. So I think that's the first pearl of wisdom, is really just consider the primary and secondary markets and determine whether the secondary market in this context, as I've articulated, in fact, is regulated. Then something else that we're working on, which I think would be of interest to the panelists and to the audience, is we're creating what we call vesting NFTs. And incidentally, as a law firm, we've actually bought a blockchain company, so everything we do is in-house. That's the tech. We also have Unity developers, so we're also in the metaverse space, and we do everything in-house. And we're putting together, working on the King's project, we're creating these addresses, but what we're also doing is we're creating debt instruments, and these debt instruments are really in the form of vesting NFTs. And the way the vesting NFT operates is you can put any crypto asset in the vesting NFT, and at a particular time or a particular date, the vesting happens. And the vesting can be any form of crypto, can be any form of token, you decide. Now, what is quite amazing around that is it means that you can issue a NFT, let's say, as a debt instrument, but you can also have the collateral in relation to the debt instrument embedded in the NFT. So if there's a default, immediately the collateralized, the perfecting of the collateralized security can take place immediately. And I think that's one key use case, which it's a real game changer. We also, I mean, it's a bit off topic, but you take the definition of derivatives in every jurisdiction, and you'll see the counterparties to a contract. What we're doing is we're creating these NFTs where we're pointing ICO vesting contracts to these NFTs, where there's a vesting, let's say, on an annual basis, but that essentially creates a future, and it can be over a period of 30 years. And you fall outside of the definition then of a derivative, certainly in South Africa, and I think around the world, derivative, a future derivative, that is. So the take home from today is really to the attorneys out there, there's a lot in the textbooks, and I'd urge everybody to look at those textbooks, go back, look at old legislation, particularly when it comes to negotiable instruments, and there's quite a bit to find there. Secondly, when it comes to regulation, apply your mind as to how the secondary market could in fact be regulated. And I know for a fact that it's not even on the regulators' minds. The DeFi space, I consulted with our Reserve Bank, our central bank, about a month ago, and it was all about cryptocurrencies and the regulations of cryptocurrencies and NFTs and crypto assets. The moment we went into the DeFi space, they said, we actually give up. I raised the issue, incidentally, of the derivative and the fact that no counterparties, and that's something that's not even on their radar. And they just said, we give up. There's nothing we can do. And they're digging their heads in the ground. You know, so when it comes to Simone saying that the regulators are late, in South Africa it's quite peculiar. The regulators here believe that we're not regulated in circumstances where I believe that we are very much regulated. In fact, I was telling Jonas before the discussion that what we're doing is we're actually going to take a public company listed on DigiShares, and I'm going to write to our stock exchange saying, tell me whether this is acceptable, whether this is regulated, because everybody's saying it's not regulated. And you'll see the moment our exchange gets wind of this, they will get legal opinions and suddenly we will be regulated. But I don't believe that regulation will be able to close every gap that's going to arise in this space, because the moment you think creatively, when it comes to debt instruments, secondary markets, you're going to find that the regulators won't be able to keep up because it's far, far too slow. Just take the vesting NFT as an example to conclude. Think about how long it would take a regulator to actually take a vesting NFT and regulate it as a derivative. I mean, that's not even on the radar because vesting NFTs have really only come to the fore now. So that's my 2 cents worth. Thanks, Jonas, and thanks to the audience. I will be here for questions after the speakers at the Fireside Chat. And please, with any questions around this, let me know. Thanks so much.
Interesting. Thank you, Maurice. And yeah, see you in half an hour at the Fireside Chat.
Thanks.
Okay, so next up is Axel von Goldbeck, partner at Möhrle, Happ, Luther. Axel will now present us to Tokenization of Debt, the German way. So, Axel, welcome, if you're there. Yeah, can you hear me, Axel? I cannot hear you right now. Hello?
Hello, can you hear me?
Yeah, there we go. Yeah, we can hear you. Axel.
Yes, hey, hi, can you hear me?
Yeah, clearly.
I can hear you. Can you hear me, right?
Yeah, yeah.
I'm not allowed to stop my video because you say you stopped it. Here we go. Okay. Thank you. It's good for sharing my screen. Hi, everybody. Thanks for having me here. I have a small presentation for you. I can easily build on what Simone and Maurice has already presented. if you have no particular interest into the German way, take it as an exemplification how things may work, how things do work in Germany, how things may work in the EU. You know that Germany is is a major player in the EU. And the EU is, of course, interested in harmonizing securities law. So, which is basically underway or has been done by MiFID and maybe continued. So, let me change my screen. Oops. So can you see my screen?
Yeah, but it appears to be blinking. Oh, okay, no more. It looks good.
Yeah, that should work. Okay, so some basic truth has already been provided to us. There are a number of economic advantages in tokenizations, but everybody has to comply with the laws. And there's some fundamental, I wouldn't say obstacles, but challenges, of course, to do tokenizations everywhere, and of course in a heavily regulated company, a country like Germany, it is the same. Tokenizations take place where no form requirements exist. German law, like most others, provide for a multitude of formal requirements, e.g. written form, notarization, certificates, registrations. Where this is in place, tokenizations don't work. And this is especially the case in real estate. It's a high value asset. The government wants to protect investors as far as possible and create certainty where certain rights may lie. And this is why we have all these form requirements which do apply to real estate tokenizations. But we are not talking about real estate. We are talking about debt, basically financial instruments. There is at least, or there used to be one form requirement in German law, which is maybe a unique feature because it doesn't exist in other jurisdictions. But in Germany, we had a certificate requirement until recently. I will come back to that later on. And yeah, if you need a certificate to create a security, you cannot create a digital security. These are the civil law challenges, of course, as usual, and as Maurice pointed out correctly, there are a number of financial regulation challenges. The good thing is the German issuer do not require a license. If you issue a bond, that's fine, but still, of course, you are acting into a regulated environment. If you offer a real estate investment, you may require a license under the IFMD directive. I will not elaborate on that because it's a EU specialty. And of course, if you need services to help you and assist you in your issuing and managing your bond, they almost always require a license. It's costly. And on another level of regulation, you have disclosure obligations in issuing any security. Still, in spite of these obstacles, German lawyers managed to create a bond, a digital bond, even before the recent legislation was published. It was pretty complicated. It was actually a tokenized contractual hybrid instrument, which means it was debt in form, but it was treated as equity due to its subordination. That was very special, but it was a real breakthrough because it was made in form of a public offering.
Axel,
and it was, yes?
It seems that it has entered we see your email now instead of the presentation.
See my email, okay. So sorry, then I switched back. Can you now see it?
Yeah, exactly. And also one here from the Q&A, I ask if you can start the presentation.
Yeah, sorry for that.
No
and I apologize that I'm looking at the presentation and onto my camera. Anyway, this was this first German bond, which was actually a contractual instrument, was qualified as a security by the German Financial Supervisory Authority because it met all the MiFID requirements. So suddenly we had a digitized security, at least not under civil law, but under public law, it was a security. That was great. Of course, it triggered all license requirements for all sort of service companies. And it created capital market information requirements like prospectuses or security information sheets. But still, it was good enough for the regulators to reconsider the existing regulations, especially as it presented the original freely created security token had one big downside or several big downsides. There was no security infrastructure applicable, like custody, trading infrastructure, placement agents, market. They did not exist. So the German regulators started to consider introducing a new law that was enacted finally in June last year, and it was called the Electronic Securities Act. That was the first time that German law provided for a digital security simply by the deletion of the paper certificate requirement. It sounds very easy. In fact, it was a major discussion, especially amongst lawyers, because this digital security was qualified as a tangible asset, right? Although it's just code, we now have something that we call a Sache, a tangible asset, which is pretty useful actually. Still, we are in the state of exploring regulations. The government and the lawmakers decided to give the act only a very limited scope, which means bonds and covered bonds and investment fund certificates. This is quite a large market actually, but it still doesn't cover what is pretty exciting, shares. But we cannot issue shares in Germany on the blockchain presently. So how does it work if there's no paper? The security is created by registration in a centralized or decentralized register. So the lawmakers want to not focus on any special technology. So it provided for a centralized electronic register, but we haven't seen any centralized electronic security so far, and it's not expected that this may take place very soon. But we have seen a number of crypto securities offerings, and this is a growing market. So registration is necessary to create a digital or crypto security. Running such a security register is a licensed business and requires a license, which is again not easy, but it's the core element of the regulations. And I think it's quite useful to reassure investors. The transfer of security is only effective when it's registered, and the register to keep it in a nutshell, the register is obliged to inform all investors about their holdings every here and then, at least once a year, or if you request this information. So the register is the core of the whole system, which is quite large. Actually, I will show it to you in a few minutes. That there are other players that you need to issue a crypto security in Germany. The German Electronic Securities Act provided solutions for quite a number of bigger and smaller issues original securities or the crypto securities had. So now we do not discuss anymore how such securities may be created. How do you make sure that in a transaction all rights are transferred together with token, because the token is a security. It's not a digital representation, it is a security. We do not wonder how the buyer of a token can make sure that the seller is entitled to sell the token, because only registered investors may sell their tokens, and other smaller and bigger issues are settled, which is good for investors, especially for big investors, because it creates better investor protection, and this finally will result in a larger market acceptance. If you look at this chart, you can see that the phase in eliminating intermediaries on the blockchain, well, has to be true. It's actually a myth. On this side here, you can see the very basic setup. If you are a corporation, you want to issue a bond, you at least need a securities register. You do need a crypto custodian. So this is just key custody, actually. It's not securities custody, it's just custody for private and public key. Of course, you always need investors, but if we elevate the whole industry to a more professional level, we will have the usual banks, we need exchanges, we need securities custodies, and maybe crowdfunding platforms. So you can see that that is quite a setup you need to manage once you start offering crypto securities. Of course, this is all going to be standardized. It was a difficulty for the first investors, of course, but for the tens, for the hundreds investors, it will all be settled and hopefully work easily. But at this stage, you can see that it's not easy. And it will probably never be easy, but it does work. I am advising on a number of security offerings. There are, of course, a number of technical obstacles, but finally it does work. And once it's all set up, the automation and digitization aspect will prevail, and it will become pretty easy, hopefully. Where do we stand? Just a bit of market information. We now, so 12, 15 months after the enactment, we have only 4 offerings altogether. This includes real estate offerings and general offerings, just 1 public offering. So it's still in a very explorative state. No institutions have so far offered crypto securities. This is due to some lags and gaps in the compliance setup and the legal infrastructure. But this will all be done hopefully this year, and we see institutional investors and issuers entering the stage slowly. So the expectation is that sooner or later all securities will be offered as electronic securities, most likely as crypto securities. And finally, the government plans to provide for electronic shares, something that may exist in your countries already. It does not exist in Germany. And of course, this will, based on the experience we made with bonds, with debt, this will grow the market even further. So the future is bright. The initial issuers had some challenges to overcome. But once this is being industrialized, I think it will become the new normal. And in a couple of years, we will not talk about technology and what protocol is relevant and is the best. It will just happen, and all securities will be issued and dealt on blockchain. This is it. 15 minutes was my time. Thank you very much for your attention. And I'm happy to answer questions, of course.
Thank you so much for that, Axel. I don't think we have any questions right now. I see there's one in the Q&A, but we don't have time for that. So if you have any time to spare, feel free to go into the Q&A and answer the question. And I hope to see you in 15 minutes at the Fireside Chat. Okay,
you will.
Sounds good. So yeah, and now for today's last presenter, Bryony Withop, who's partner at DLA Piper, sorry. And Bryony is skilled in transaction structuring and financial funds, broader lending platforms, including blockchain-based offerings, and digital assets, including token structuring and issuance. She's passionate about sustainable finance and investment solutions, including green, social, and sustainably linked instruments, transition finance, and impact vesting. Bryony leads the fund and finance team at DLA Piper in London and regularly writes articles and speaks on relevant topics. She's a member of the Advisory Council for Global Digital Finance, co-chairing the Stablecoin and Digital Assets ESG working groups, and is the Sustainability and ESG lead for the financial services sector at the firm. And she'll now present us to tokenization of debt from DLA Piper's perspective. So welcome, Bryony.
Thank you very much. Can you hear me okay?
Yeah.
Great. Okay, so I've got a little presentation today touching on some interaction between tokenized debts and the potential to use that in social bond and social impact bond applications. And the presentation is called Going Beyond Green. And I had anticipated perhaps a little more discussion. We did have a little bit at the beginning, but perhaps a little more discussion about, in particular, the way in which ESG-related debt and green bonds are currently really lending themselves to tokenized form. So when it says going beyond green, that obviously implies that there is a very valid and active and very hot market out there at the moment in tokenization of green bonds. Before we get into this slightly more horizon topic of social and why tokenization lends itself in the social bond environment. I also don't think, in case I missed it, that anybody so far has mentioned the ICMA digital assets kind of FAQs, digital bond FAQs that were put out recently. They are a very handy public reference document, so frequently asked questions on DLT and blockchain in bond markets. And they contain a kind of overview of a lot of the structural themes that we've talked about today, some of the kind of trading and transactional type differentiation between traditional bond markets and digital bond markets. And they certainly don't provide all the answers, as no one can, but they are a very useful public resource for sort of summary and kind of overview in this area from the International Capital Markets Association. So I do recommend looking that up if you haven't already. Okay, so let's move to this presentation. Let's see if I can. Okay. Struggling. Just a second. Yeah, is this going to work? No.
No hurry, no hurry.
Hang on. Let's see if I can just move this around a bit. My screen is too cluttered with stuff and I cannot get in here. No?
Yeah, otherwise I think that will suffice. We can easily see your screen.
Can you see it fine?
Yeah,
okay.
At least it works for me.
All right, let's stick with this. I'll probably just make it worse. Good. All right, so tokenization of debt going beyond green. As I said, that obviously implies there is a kind of a green bond play here, and there absolutely is. But I thought we might discuss that more, so maybe we can in the Q&A, but let's move on to ESG generally as a catalyst for tokenization is yeah, hugely important. Okay, and one of the main reasons is because of the promise of the ability of a tokenized instrument to be able to deliver on data. So to be able to deliver on both the connection of the initial investment to the ultimate purpose, ESG related purpose of an instrument, and also in the reverse, the ability of that tokenized instrument to be able to deliver on the data and reporting that needs to come back from the kind of target or application of the proceeds back up to the investor. So I see the impacts of ESG being yeah, huge catalyst in the tokenization space, in particular around tokenization of debt. So the first slide here is going to talk about social bonds. So beyond green bonds, we also have a social bonds framework, internationally recognized social bond principles, again, as issued by ICMA, the International Capital Markets Association. There's a definition up here. So a social bond is a use of proceeds bond that raises funds for projects which target positive social outcomes. Some of the categories that you could apply this to include kind of project financing, including funding basic infrastructure such as clean water, sanitation, healthcare, etc. Real estate, including around affordable housing, purpose outcomes, and then programs funding, things like programs for employment generation and sustainable food type programs, including regenerative agriculture. So if you think about a debt instrument where the investment monies are being raised to target a purposeful outcome, the benefits of tokenization in this respect are the ability of the blockchain underlies the issuance of the instrument to evidence in like an open, auditable way the direction of the proceeds from the investor at the top to the outcome, and obviously potentially as well in a more disintermediated way. So unlike, you know, a traditional kind of financial market structure where proceeds may be passed through many intermediaries and there's potentially a lot more financial inefficiency, therefore, from the raising of the funds at the top to the application of proceeds at the bottom. Tokenization again may have the effect of being able to disintermediate that chain somewhat in order to get that direction of proceeds both open, verifiable, and more efficient and direct. I've mentioned in connection with green the data sharing, so being one of the key kind of drivers for adoption of tokenization in this space, the ability again for the instrument itself to be able to share relevant reported data back up to the investor, and also to kind of evidence the chain of that data from the applied purpose right the way back up to the top. And that's really important in the context of increasing mandatory frameworks for stakeholder sustainability related reporting, and for the kind of frameworks that set reporting obligations around ESG related instruments. Also, tokenization can be relevant for purposes of expanding the investor pool and for fractionalization. We've heard a little bit about that from some of the other speakers today, but being able to potentially break down the investment units into both digital units, which may expand the pool for which investors are available to invest in those units, and also into smaller parts, the fractionalization aspect, in particular for things like you know, large infrastructure projects, for example, being able to break up the financing or the investment units for that into much smaller has been raised as another potential benefit of tokenization in this area. And finally, liquidity. It was mentioned earlier, particularly in relation to real estate, and we'll come on to look at that a little bit more as well. But being able to provide investment instruments in this kind of area that don't necessarily need to be held for the full long life cycle of like a project financing, for example. The investment traditionally would need to be held over very many years, 10 years plus. Being able to offer instruments which are tradable in the meantime and which can provide, therefore, the investors with additional liquidity is a clear draw and a clear kind of market making motivation in this space. So social bonds are hot topic. Social impact bonds. So these are a novel, or fairly novel form of funding which is usually applied in a purpose where there's less potential economic return from the underlying application of proceeds. So where the kind of returns profile for the investment is not going to be fully commercial. Social impact bonds create more create more commercial return by using a funding commitment from an outcomes payer. And that outcomes payer will pay based on the project achieving certain outcomes. That promise to pay creates incentives for other stakeholders, commercial incentives for other stakeholders to invest in debt issued for the purposes of achieving those outcomes. So categories of impacts, like I said, it's things that are like less commercially viable returns. So supporting refugees, displaced populations, access to free healthcare, tackling homelessness, reducing reoffending. These types of impact orientated targets are relevant in the social impact bond space. Why is tokenization potentially relevant here? Well, I've negotiated some of the documentation around these, and some of the core things that come up are around the trust and auditability. So relating again that outcome back up to the kind of third-party auditor and up to the outcomes payer is very easy to evidence, or much easier to evidence in like a blockchain-based system where you've got that immutable auditability and open trust space. So I think using the blockchain in order to provide for trust and auditability in structures is a key draw. Data sharing, again, very relevant. Obviously, if you're trying to evidence that your application of funds have achieved the purpose of a project, in order to release this outcomes payer money at the top, then you're going to need to be sharing a lot of data over the life of the project to evidence that. And finally, then potentially also value sharing and democratization themes. So social impact bonds often have community-related intended outcomes, and so the ability to potentially share some of the value that arises from the project with the community that's being targeted and participating and engaged in the project itself is another more flexible aspect of the kind of tokenized environment versus the traditional environment when you look at issuing around social impact. I've got like a minute, so I put in a case study here about affordable housing. We've already heard a bit about housing, and I think it would be really interesting to talk to OwnEZ a bit more about the affordable housing space. But there are various projects in the blockchain-based space that are seeking to disrupt the affordable housing market to boost affordable housing provision, to offer more liquid investment opportunities, to link these investment opportunities with this kind of ESG related finance, social bond type environment. And then potentially in the future, there are benefits of being able to add on features through tokens, as I put here, the potential, for example, to recycle a percentage of investment returns into outcomes payment pots for associated social impact projects. You can see how social bonds and social impact bonds can be very closely related geographically and in the way that they impact on people. And so being able to link these types of tools together through tokens, I think is an incredibly exciting opportunity. In addition, that tokenized investment piece at the top can be matched with token-supported flexible ownership models for clients, and particular partial ownership models really do lend themselves to this type of management. including the type of flexibility where you could enable people to have kind of part ownership, part rental models, which are able to adjust depending on people's economic conditions at the time, without kind of reams of bureaucracy to go through in order to enable that, so that the structure can react to economic conditions. One of the biggest issues around affordable housing is people hitting economic shocks or losing their jobs, etc., which means that then that housing security is lost, and that causes a lot of issues in wider society. So being able to create flexible debt, kind of real estate homeowner debt tools that can help to bridge those moments would be also incredibly beneficial from a social perspective under the ESG umbrella. So I'll stop because I'm 2 minutes over. That was a bit of a kind of canter through, but I'm happy to answer more questions on this and also on the green bonds topic as well, if people want to talk about that. Thank you.
And thank you, Brownie, for that. Okay, so that was the last presentation for today, and we'll now round up the webinar with a panel discussion where we'll discuss today's topic and also answer some of the questions typed into the Q&A, and also some questions you sent to us beforehand. So yeah, presenters, if you could all join the stage. And I think we will start with Swapnil, who got cut off before. There is this question in the Q&A. You can all go read it. But essentially, the question is, how can we bring liquidity to real-world assets funded on-chain as we have for the same kind of liquidity as we have for, say, DeFi protocols such as Aave and Uniswap?
So the heart of the question is, how do you bring about liquidity in illiquid assets? And as you can imagine, liquidity is a very non-linear phenomenon. If it's initially it's low and then it picks up, it becomes self-fulfilling. But then getting it off the ground is the hardest challenge. And if you especially have assets which are dissimilar, let's say equity is equity from a company, but bonds could be of 10 different types. So it's not so easy to create liquidity in bonds of even the same company. So one possible approach is to create mutualized super tokens from these tokens, which are smart contracts, of course, and then create liquidity only in the super token, which represents a theme, which could be, let's say, all companies in issuing green bonds in Germany. That's just one theme. So all 50 tokens, which are green bond tokens in Germany, become part of this super token. And liquidity is there primarily in the super token, and each token can swap itself, or the holders of tokens can swap it for the super token before they actually get the liquidity in the main market. And so using balancer protocols or Uniswap-like protocols, you can create a fairly market-determined mechanism to determine the exchange rate between individual tokens and a super token and fiat. So that was my short answer.
Yeah, fully agreed. And that's actually also some sort of the same approach we have taken with our decentralized exchange called Real Estate.exchange. I don't know if any of you other panelists have anything to add to that. If you have any idea as to how to create liquidity for real-world assets, specifically debt, or if we should move on. Okay.
Institutional engagement. To some degree, a lot of the conversation here is related, obviously, to kind of how do we fractionalize or involve more retail investors or kind of democratize using these structures. Actually, scaled institutional engagement is another key to creating liquidity. So being able to use more complex financial instruments like derivatives in a tokenized form around this space, I think will also help to bring more liquidity into these markets. So on the one hand, I think democratization and retail involvement is important. And obviously you've got to draw a line between complexity of instruments that's relevant for that space. But institutionalized scale is also important to create the background liquidity in the market.
Fully agreed. Fully agreed. But maybe
may I add something?
Absolutely.
I have gathered some experience for a couple of years as a lobbyist for the real estate industry, and the the notion of liquidity is definitely good for property owners and all these sorts of people. But when I was talking to our Federal Ministry of Finance, I felt that the last thing they really want is a really highly liquid real estate market, at least not as liquid as the share market or the bond market, because the whole stability of the banking system and much of the wealth of almost every country is based on real estate. And just figure that we have a completely liquid market with all these ups and downs, where 10% of the whole trillion of values go bust in 2 or 3 days. That is nothing the regulator really would like to assist in. So I'm pretty I'm not very confident that that we may create a liquid market or liquid assets for real estate anyway soon, because the regulators will stand up against it.
What we are doing, incidentally, Axel, is we're creating what we call a layer 2 deeds office. So we're taking our existing deeds office, property transfers, and what we're doing is we're taking properties, extracting the property rights, leaving the bare dominium, and the rights are being traded as a layer 2. So it's liquid in relation to the property rights, but illiquid because it's going to take forever for the actual property, the real rights remain illiquid. So it's the trading of the personal rights that are liquid, but the real rights are illiquid.
What is RADS? Sorry, I didn't catch that.
What we're doing
by
is
RADS?
Sorry?
What do you mean by RADS?
No, so what we're doing is we're creating a layer 2 deeds office. Rights.
Right.
So, yes, legal rights. So we're extracting legal rights. So the property ownership, like we're leaving the bare dominium, but the legal rights that we're extracting aren't necessarily full legal rights. The rights to use the property for the growing of wheat, and those rights then get traded. But the real rights in our law, you have the real rights to the property rights, not personal rights, are left. The actual title is left alone, and it's the trading of the rights that we're tokenizing. So it's very, very similar to Mozambique. Over there, you don't own the properties, you only trade the rights. You get 99-year leases. So that's what we're trying to do in South Africa. So it's liquid and illiquid.
Okay.
Interesting. And I actually also have a question in relation to all of this. So would it be possible for let's say banks or other big financial institutions to put these tokens on their balance sheets, or would it require, are there any legal requirements such as an ISIN code or anything like that? Is anybody able to answer that?
I don't know any bank who loves to put anything on their balance sheet.
No. Yeah. Okay, so
it's a good question. Well, although I'm sitting here in the US, based on my accent, you can hear that I was not born and raised here, and I was born and raised in Israel. And the Israeli government just announced this morning, together with the Tel Aviv Stock Exchange, that they're going to explore the possibility of issuing government bonds over the blockchain. So in reality, and I think that that's a big move forward, because in reality, answering to your question, banks will be obliged to put those tokens eventually on their balance sheet once they're issued, because it will become a mainstream asset.
Yeah, fully agree.
Now imagine if those tokens are collateralized. So on a default, the collateral manifests itself. Yeah, that's going to be a game changer.
Absolutely.
Correct.
Fully agreed.
Yeah.
I don't know if anyone else has something to add, otherwise we'll move on. Okay, so let's see here. Okay, there's a question here. Which real world asset class at the moment have the largest issuance in the security token world? In 5-10 years time, which asset class in the world of real world assets will have the largest volume? Private credit, private debt, mortgages, invoices, big question. Anybody want to bite? No.
Maybe corporate bonds. If they're, as long as there are no government bonds, it's likely to be corporate bonds.
Yeah. And is there any specific reason for that?
I think that's the easiest way. You don't have the collateral issues associated with, especially with real estate. Yeah, I think this is one of the main reasons, or that could be one of the main reasons.
Absolutely.
I think you can also probably throw ESG bonds in that, given it's been the focus of what I've talked about today, but like not right now. But ultimately, you're thinking about the reasons why tokenize what, you know, if you've already got something, why tokenize it? See, there's got to be kind of add-on reasons like why that category, you know, for the first mover categories, why those categories. And I think that the data solutions inherent for ESG related issuances are very compelling.
Yeah, so that makes sense. So you believe ESG related bonds is the future?
Yes, well, that will be a major like catalyst in tokenization of debt. Yeah,
that makes sense. Makes sense.
I tend to think of private credit as the possibility for the same reason that was mentioned earlier, that the value addition of blockchain is strongest in making sure that the debt issued by a small company also has acceptance in debt issued by a big company or the government. So it sort of makes it a bit more democratic. At the same time, the community behind a business can easily support it by buying bonds issued by it, and that even the mid-sized businesses can be lucrative investment opportunities, and their contract enforcement could be significantly superior given the blockchain architecture. So that market, and then invoices is a subset of that. So small business finance through either invoice financing or private credit, I think that's a huge untapped opportunity, which blockchain can add a lot of value and hence might become quite prominent on the back of this.
Indeed. There's another question here. Can institutional investors invest in a tokenized fund unit in Europe, for example, a fund based in Luxembourg, Ireland, Denmark, etc.? And can retail or sophisticated investors invest? And I think that's a question for some of our European-based lawyers, maybe. Simone or Axel, are you keen on answering that question?
Oh, yeah, I would be pleased. The short answer from my side is just a yes. As a non-European institutional investor or retail investor, you can invest in funds in Europe. Of course, it all depends on the issuer of the fund or on the fund manager, meaning on the policies of the issuers. I have to say, this morning I had a lovely call with one of our customers based in Switzerland. He was telling me how complicated it was for him to live, and also for his family, because of his dual citizenship, European and American, how complicated it was even to open bank accounts. So this is to say that the short answer is yes, but it all depends on the company that is responsible for managing the fund in which the non-European citizen wants to invest.
It's incredibly difficult to get tokenized retail structures off the ground in Europe, to be clear. Like retail suitable tokenized securities structures in Europe, that is almost, I mean, we get inquiries about that all the time. And it's incredibly difficult to find structures that work within the current regulatory framework for retail. And in the funds market, you know, you can't tokenize UCITS. It's just not appropriate as an investment. It's not going to get past the regulatory kind of barriers. Well, certainly I come at it from a UK perspective anyway, but it's certainly not going to get past regulatory barriers here with the relevant kind of cost, benefit, proportionality. You know, once you've done the kind of cost benefit analysis of trying to get that structure past the kind of regulatory threshold versus the investment that you're likely to raise, your target investment from that segment, it just completely sends it off from a commercial perspective. So it's very, very difficult to get stretched for retail out.
We're very fortunate in South Africa because, I mean, we mirror everything you've said from a regulatory point of view exists, but we have the legislation around cooperatives is very, very, it's a different set of regulations. So what we're doing is we're taking the requirements for a share register and we're using DigiShare for the share register component, and the share certificate is the actual token. The difficulty is that's highly, highly regulated. In fact, we have to register as a stock exchange in South Africa to do that. But the moment you start using a co-op as a vehicle, none of those requirements present themselves, because I don't think it was ever contemplated that co-op shares would ever be listed. The one shortcoming is that it's one vote per share unless you're over 1,500 USD in turnover, and then you can go up to 17% voting powers, but it's limited to that. Other than that, we're pretty much, well, we're regulated, but very, very liberal regulations, which is nice.
Yeah, I must agree. The co-op is a brilliant setup.
Yeah, we're so lucky to have it.
Yeah, very, very, yeah.
Oh, if I can add, I 100% agree with Bryony. Bryony, is that correct? Okay, thank you. Sorry. Tokenize the funds and resale market, very complicated from a regulatory viewpoint. But I believe that we all agree that it's just a matter of time. So we are experiencing all those issues from a regulatory viewpoint now because we are talking about something new or something that is not in the mood of the regulators. I am of the opinion that as soon as 2 or 3 projects are approved somewhere in the world, they will open the door to similar projects. And what is now very confusing and very challenging will become more normal than now.
Simone, absolutely agree with you. That was exactly what I was thinking, is that, braving the terrain for the first time is the hardest thing, because there's all, there's no trust in something that's new, and everything that's not known scares the hell out of everybody. So, but I think there's such a force to push this that it's inevitable. So we are talking about a matter of time, because it is inevitable to use these tools to push the securities and a lot of real estate markets and a lot of other markets forward to down to a more democratic position to the people, which is, what blockchain as well, with security and transparency and all of those wonderful qualities that we've talked about adds on. So I think we are going to be the ones, if we're the first ones doing it, we'll be the ones struggling the most. We'll get beaten up, but at the end of the day, the ones that come after us will have a pathway designed, and I'm sure that these first ones will set the tone for the future, I think.
Agreed.
Can I jump in and answer?
Sure.
Are there regulations to tokenize digital assets such as algorithms and data sets? It's quite an interesting question. I'll tell you why. Because from our perspective, algorithms and data sets are subject to copyright. And the copyright laws apply to algorithms and data sets. Now, in our jurisdiction and many jurisdictions, the transfer of rights has to be in writing for the transfer to transfer rights or copyrights. So the regulations are really in South Africa would be as simple as you can trade it as a digital asset, subject to complying with the copyright laws. And it's something we're tackling at the moment. We call it a PAN, a perpetual assignment to right, NFTs. And the copyright, the transfer of the copyrights is the issue there. And I see Simone's also answering.
Thank you for that, Maurice. So I think we're going to take one last question. There's one here that was submitted before the webinar that goes like this. What is the net cost saving set of benefits of tokenized debt? And it's a big question, I know, but maybe someone out there is able to answer that. I don't know if Efri or Morne have, if you have done any internal
Can I answer? The benefit is certainly in South Africa, but in most jurisdictions, how do you tokenize debt? Where the markets? I mean, the bond market in South Africa is primarily government bonds. I mean, to enter the bond market is really, really difficult. And if you take my primary and secondary, the notions of it, well, the primary can be unregulated, and then the secondary is you create liquidity, the person can trade it. So it really creates new entrants into the market. And the moment it's tokenized, the primary people will know that there's liquidity in relation to the secondary market. So it makes it far, far, far more palatable, and hopefully it will create liquidity.
Well, from a legal perspective, the cost of the entry cost is significantly lower. I guess that the challenge is the marketing, because once you take an instrument public, obviously you're being significantly exposed to certain kind of investors. Overall, I think that it's premature for us to estimate how much money will be saved. I took a company public here in the US before, and it's extremely expensive. So I agree with Maurice that here the ability to exposure and have liquidity as the primary investor is a deal breaker, and most probably will reduce significantly the cost in comparison to any other option.
Yeah. Okay, so anyone else have anything to add as a final note?
If I were to put a number to it, I would say that the cost of issuance is typically somewhat fixed. And that's why, unfortunately, for large issues, fortunately for large issues, it's as a percent of issue size, it might be as less as 1%, 0.5%. Government pays close to 0. But a private credit issuance could be as costly as 4-5% in the conventional setup. Blockchain use, just to make it higher governance, easier to track, etc., could reduce the cost to almost 1 to 2%. I'm just giving very ballpark numbers. More importantly, the enforcement of collateral in a private context could be also another 3 to 5 percentage points of cost, but in a blockchain smart contract driven context could be as low as 0.1%. So I think that's the order of magnitude we're talking about for small issuance in particular.
That makes sense. Thank you for that, Swapnil. Okay. Yeah. Do you have anything to add, Morne?
No.
Oh, okay. Sorry. Okay, so yeah, thank you all for that. I think that's it for today's webinar. Thank you all to the great panelists, presenters for being here. Appreciate it very much. And to the audience, if you have any questions that didn't get answered, I believe most of today's presenters can be found on social media. So yeah, you can try to reach out to them on LinkedIn, Twitter, or other social platforms. And yeah, lastly, I just want to thank you, all the attendees. It's great to have you, and I hope to see all of you again when we start our next series of webinar in the beginning of the new year. So until then, have a great time.